Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs report and how the Fed reacted, as well as mortgage rates. Logan, welcome back to the podcast on this Jobs Friday.
What a wonderful day, a wonderful week. A lot has gone on. This has actually been one of the more informative weeks since we've done this podcast. A lot has gone on. And it's Jobs Friday, of course, which means it's Jobs Week. And we had Treasury, Trump, all this stuff happened this week. So it's a good day to review everything.
It is. Okay, give us the headline number and what you think it means.
So hopefully by now, everyone listening to this podcast, now that we've had another wave of revisions, we can understand that there is no cabal out there about the labor data. Labor data gets revised, right? You get a business survey, and then after a year, you could actually get, the tax information to see where the numbers are. And the numbers look pretty much in line to my forecast, so they look correct. A labor market has been getting softer really now for 18 months, but it's not breaking. So we had positive revisions to the recent months. We've had a negative revision adjustments. And even with the negative revision adjustments, we are 1,000 above my 2024 forecast in terms of job growth. Wage growth still is probably a little bit too firm for the Fed. Manufacturing jobs still lost in 2024, grew a little bit in this last report. Government jobs were the big surprise in 2024. That's probably not going to happen in 2025. So labor data getting softer, not breaking. Private payrolls, 6 months still not under 108,000. That's kind of my key level for that sector. But same theme, softer, not breaking, which means for the Federal Reserve, they need the labor market breaking to really change or pivot in a bigger fashion than what people are looking for.
So, that's the big question is like, what is the takeaway for the Federal Reserve? What is the takeaway for the bond market? So what happened after the report came out?
So this is the interesting aspect. The 10-year yield shot up vertically. And then we had the Michigan inflation expectation survey, which is absolutely useless. This is a pile of garbage. It's absolutely garbage. The survey is so garbage that it should be discounted because it's basically a political ideological view. We had such a surge in inflation expectation because every Democrat thinks that we're going to have massive inflation now. And then every Republican doesn't think we're going to have any inflation. We're not getting the inflation of the pandemic. I mean, we are sitting here this is a good thing for everyone to remind themselves. We are sitting here in February of 2025. We have $36 trillion in debt. We had a global pandemic. We have everybody screaming tariffs, inflation, everything. Literally, the PCE inflation data has a 2 handle on 3, 6, 12 months, right? This obsession of breakaway inflation that, needs a lot of things for it to happen, like in the late 70s, it's just not a thing. And a growing economy has inflation. This is why the stock market always rises. Growing economy, profits rise, prices go up. That's how it's been done since the Peloponnesian War, Sarah. We've showed you the charts on this as well. But in this context, the inflation expectation data, if it was taken at face value, the Fed would have to raise rates Monday.
Wow, right? Really?
Yeah. That survey, if you took it at face value, is a huge expectations from Democrats on inflation. And then the other side is just as incorrect. There's no inflation coming from Republicans doing the survey. So it's absolutely useless. I am hoping that I might give the Fed too much credit, that they kind of look past this. Right? If this was a normal situation, then it would be a big deal. 10-year yield spiked up vertically after the labor report. It hasn't moved too much. Mortgage pricing, not that much, not that big of a damage. This is what we did that. We do mortgage rate updates early in the morning after we take in all the economic data and how it's digested. And what I talked about this morning was that the 10-year yield's up, but the pricing shouldn't be that bad because whenever yields have gone up in any kind of aggression form, the spreads get better. So we had a very minimal increase in mortgage rates today. And again, that's the story really since 2024. The spreads are still, getting better. They're improving. They're limiting the damage on the upside. That was the big story in 2023 that I still think it never got enough attention. The spreads were getting better in 2023. Then the Silicon Valley banking crisis threw everything. The whole year was just shot on that. Would not have had 8% mortgage rates if that didn't occur. So spreads being good today, I think everyone could see it on the pricing side. So that was the bond market mortgage rate reaction.
So, this is always the conundrum for me when we get these labor data. It's not like we want to see people losing their jobs. It's not like, but yet it's like a great booming economy, all that growth. It's just not good for mortgage rates, and that's not good for our industry,
Article I wrote for HousingWire. What's funny, Sarah? That was because the trade war tap dance was ending.
When was that?
That was, I think I wrote it late 2019. We published it in 2020. But I was talking about, listen, the trade war tap dance is ending. The economic data is actually getting better. Nobody's paying attention to it, but that actually would not be beneficial for rates because yields had a one handle. We had a one handle on the 10-year yield. Oddly enough, we never broke above my key level back then at 1.94%. So, a better economy, and if the Fed is still trying to balance the economy, then 6% mortgage rates might be a problem. Oddly enough, Neil Kashkari came out today and talked about, we might need rates lower in the second half of the year. Lori Logan, Fed President Logan, yesterday said, if the inflation gets down to 2%, we still might not cut rates, right? Again, everything labor. Now we get to see it. It's 2025.
Yep.
It's one of these things where if the growth rate of inflation was the main driver, we'd have mortgage rates would easily be 6% around there, even under that. But that's not what they're removing on. They're keep on hiding behind the labor market because they want to stay as tight as possible until they cut rates because they thought the labor market was breaking, so they wanted to get ahead of it. Now they're like, okay, we can take our time. So this is actually consistent with the mindset after the Fed. See, if we could just go back in time, Sarah, whoever spiked the Fed's eggnog, we take that person out, right? We wouldn't let that happen. And then everything, they would have never raised rates after 4%, right? The curve would have been much different. Again, 70% of the 10-year yield and mortgage rates really were on from Fed policy. So think of it in that light, it'll be a little bit easier to understand. So, but this is the world we live in. We just have to deal with it as best as we can. But where Fed policy is, economics still growing at 3%. The 10-year yield being at 450 is pretty reasonable.
Remind me again, it's 323,000 on the. What is that jobless claims, and you think that's what would move the Fed?
So this goes into the 2020 recession thesis that I think everybody was all in on home prices crashing and the recession happening, and the early labor triggers weren't there. So I said, don't go into the recession talk until jobless claims get to 323,000 on the 4-week moving average. We're at 217,000 right now. So it's got to head that way. And then the bond market will get well ahead of the Fed, but we're just not there, right? The labor dynamics, the demographics, the structural things are much different now than what we saw after 2008. So this is why job openings are still elevated. The job openings data this week, again, a bigger miss on the headline, still same story, softening, but not breaking. We're just trying to get the Fed to you don't need to have, too drastic of a policy. You don't need to wait until the labor market breaks. Because again, the key to everything, and for those of you that read the article, you can see the residential construction workers. That's the key to economic cycles. Manufacturing jobs already lost. We're a consumption-based economy. So policy getting too tight eventually infiltrates the labor data. We're just not there yet. So we're hoping we avoid that, right? Because we don't want people losing jobs, families losing jobs, children have parents that don't have work. Not a good thing. We know,
not a good thing.
We have some crazy stock trader men who sit there and go, we're in a recession because we have to cleanse the excess capital. Sarah, can you feel my vibe versus stock traders? Can you just?
Oh yes, always.
Lord have mercy, for a bunch of people for 14 years got the U.S. economy just absolutely abolished them, and this is why we focus on economics, macroeconomic cycles. Be careful of middle-aged men podcast stock traders.
No, I totally get your vibe on that one. Okay, let's talk about like what does this mean for the spring housing market? Let's talk about what the tracker is showing you and what you're looking for. That tracker always includes 10-year yield, mortgage rates. It looks at what the home prices is doing, home price reductions.
So Mike Simonson and myself were a little bit different in our forecast this year. I had lower price growth based on the equilibrium models of I don't believe in the mortgage rate lockdown. I believe inventory can grow. And if inventory grows and rates stay elevated, price growth should cool, which is a positive for me. This is all a positive. And in that context, what we're seeing is that the price cut percentages are curving a little bit higher earlier, which to me is perfectly fine. That's what I want to see. I want to see a more balanced housing market. What you never wanted to see is what we saw during COVID, escalating home prices. Even in 2023, home prices still stayed a little bit too high, considering it was the one of the weakest home sales. I would argue probably the weakest home sale year ever, adjusting to the workforce. But now we get a little bit more balance and we get new listings data growing. We get more sellers. You get a functioning housing market. My understanding, just from what I visually see out there, is not a lot of people have tracked economic housing cycles. So it's odd to them to see inventory increase and home prices not be falling. On a national basis. It's actually very common to have sales and inventory data grow. It's very uncommon for national home prices to fall, right? So there's going to be, we're working our way back to something normal. So I'm keeping an eye on that. It's February. I'm hoping by this time we're starting to get, I don't want the seasonal bottom to happen in March or April. It should be happening. Yeah, it's too late. It should be happening around now. And then we see the season. And it becomes a housing market, which really isn't that, it's not supposed to be that exciting, really. It's just demographics, affordability. We just have some people that took advantage of 2008 and are still like, oh, Sarah, we got to teach everyone this lesson. One of the doomers, this person literally took a San Diego inventory. Literally, this person cut off the left axis of all the charts with, it looks like an eraser. It looks like a child, looks like a 4-year-old child took an eraser and cut off all the data to the left side. And then says, oh, inventory is really picking up, stops the inventory data right at June and July of 2024. It's 6 months old, where any functioning person who has the internet could just go up to the Fred chart and take it and go, oh, it's updated. It looks a lot different now. These people are a plague, right? They're an abomination to data that they should have no business talking about economics. And I was like, okay, so I'll debate you right now, but you're going to give me your price forecast. Give it to me right now for 2025. Oh, well, listen, I'm going to give you my 2024 and 2025. You can do the same. It takes like 5 seconds. Click, click, zip. Y'all don't want any.
I think here's the thing. Like I was in San Diego last weekend. I'd stay there through the week for part of the week for Optimal Blue. And I'm just telling you, we were, my daughter and I were looking up houses as I do everywhere I travel somewhere. I'm like, what do houses look like? What could you buy something for? Listen, San Diego needs all the inventory they can possibly get. If they were getting more inventory, good for them, because it is still wildly unaffordable in San Diego.
So one of the stories that I like to talk about on the Nerdtory is Mike Simonson, president of Altos Research, right? We have the Altos data. He like people always say, like, what were you guys thinking in 2007 and 8? Literally, Mike Simonson went up to Lehman Brothers at an event and said, hey, listen, I've started this company. This is how we track data. We think it's more prolific and everything. Lehman Brothers said, I've got 85 analysts. Stock traders again, Sarah. Stock traders. Wall Street, arrogant men. I got 85 analysts. I know what we're doing. Mike said, okay. Oh, Goldman Sachs is there. I'm going to go walk over there. Goldman, homie, hey, listen, I got this data. Goldman, on the other hand, said, whoa, oh, this doesn't look good. All right, Goldman Sachs shorts the housing market, makes $10 billion. Lehman Brothers go out of business. We believe we are the most prolific housing data trackers on planet Earth. We are not shy about it either, Sarah. When stress happens, we'll see it in the new listings data. We'll see it in the price. We'll see this because we saw there was only one period in U.S. history post-World War II where we saw national home prices crash. And the data was very transparent there. So If something happens, those that read the tracker every single weekend, who are way ahead, will be the ones to tell you. And then you have the knowledge. You could tell Uncle Dave, right? Everyone's got Uncle Dave in their family. By the way, there's 7 people that I've met that actually have an Uncle Dave that does this.
I have an Uncle Dave.
Yeah, but does your Uncle Dave tell you, home prices are going to crash in 2008? No. You kids are crazy to buy a house. You should rent for 40 years. Then baby boomers are going to die. And then you buy. It's like, in any case, do you think people either go there and go, well, if we wait 37 years, there's going to be a lot of inventory because people live their lives daily all the time, right? That's just how the world works. You don't just basically stop. Are there men out there that fall, prey to the YouTube people? Yes, of course. I actually so far I've liked what I've seen in the tracker data. We just want to see it kind of grow because at some point, mortgage rates come down to 6%. We have more choices, right? It was not comfortable in 2020, 2021, 2022. Of course, that was the savagely unhealthy housing market. 2023, okay, not good. But now it's like starting to look normal again, and that's a good thing, right? Of course, there's insurance issues, taxes issues, Texas and Florida, all that. So we get that. But as a general country, it's very, very hard now that we're here in 2025, which I was not supposed to be talking about economics. I was supposed to be done. The NAR's inventory data is 1.15 million. We're not even at 1.2 million. We were told 26 to 32 million active listings because of the silver tsunami. We're not even at 1.2. And this is after the 3rd calendar year of the lowest home sales. It's different. Credit channels run inventory channels. We did that podcast last year. It was very popular. Trying to explain what's so different about now than the previous decades. And the credit markets are different and people are staying on their homes longer. And this is how economics is supposed to talk. And I know it's not the most exciting thing in the world, but I'm trying to make it as fun for everybody as possible, right?
So I was just at the servicing conference and, they brought out the latest delinquency numbers, which are up off very historic lows. But they were telling people, they're like, but if you look at it, it's still a very small number. It's still a very small percentage. And they were very upfront about that. But what I think that you mentioned that we have to watch out for is insurance, because insurance prices have gotten so mad.
We have the freshest data. So if we see stress from insurance, which the western part of Florida would be it, the real estate investors and the Wall Street firms that actually use our data lines, that's kind of what they look for. Is that you'll see the new listings data pick up out there. Also, the theory that people are just hunkering in their houses and doing what they can because you can't sell your house to, because you can't get a mortgage. Condos are more prevalent to get hit in that kind of marketplace. So again, it's an issue, but as general as the economy goes, we're still not back to normal. I was really hoping we get back to 2019 inventory levels before 2025, but depending on the time of the month, we only had 10 states that got back in there. And remember, 2019 inventory levels, for everyone listening, was the 5-decade low before COVID. This is why I said, it was like, oh boy, inventory just crashed. This is not a good thing in 2020. Like, that was the reason. We were already on the razor's edge on the active inventory. We have a lot more people now. Right. This is why we do those crayon. Crayon economics is designed to not do technical levels. By the way, for those bond traders that troll me on Twitter, your technical levels thinking on housing charts are useless. It's just a crayon direction to show you a trend, not technical levels. We're not going to have a liquidity crisis when X is broken. We're just here to show what happened and why this time in history. Remember, this is like we got 5 decades of information. This is a historic event, but we could try to explain it because people buy a home, Sarah, to live in, to raise your children, to go to work, to have sex, to have friends over, to watch the Super Bowl. By the way, you know what? You're a Chiefs fan. I'm a Niner fan. Last week, I actually went back and watched the Super Bowl last year. It was just, I did it as I did it like my old high school basketball coach self. I looked at all the plays and everything. I counted 27 plays that the Niners screwed up on. The punt, fumble was terrible, but man, a lot of blocking misses. Tough, man, tough. So like Christian McCaffrey said, I hope both team loses this weekend. right? And just let's get the draft going. Let's start it up again next year.
You tortured yourself by watching that. Oh, that was so sad last year. But I wasn't that sad because the Chiefs won. So,
Never look away. Blood stays on the blade. Gangs of New York.
Gangs of New York. All right. Well, we are almost out of time. Thank you so much, Logan, for being on today. And everybody, by the time this comes out, you can find the tracker. We publish it every Saturday, and it has all this information and more.
I encourage everyone, go look at the labor article, and you could finally see the formats of my labor recovery model, which is, again, a lot of people were thinking labor data is fake. The jobs, listen, if jobs were crashing, jobless claims would be rising. That's how economic cycles work. Okay, so I realize some of you have been told for 2 years that the economy was terrible and we're going into recession. And I understand everyone being in the mortgage and real estate industry, that's what you want to hear because you're hoping that rates go lower off of it. That was not correct. So if you want to keep on listening to that person, that's fine. But if you are trying to tell your clients or anything, oh, mortgage rates are going to come here, listen, ebbs and flows with the 10-year yield, right? We do charts, right? We do channels. Rates can go down and up. But if you're going into the sub 6% mortgage market world, you really need the labor data to break. And we're sitting here in February of 2025, mortgage rates just a tad of over 7% because the labor market hasn't broken yet. If it did, the bond market, trust me, would so go ahead of the Federal Reserve. They are so ready to go. But where Fed policy is, where growth is, inflation, the 10-year yield at 450 makes sense.
We are hoping for those lower rates as we head into spring. Hope we see them. Logan, thanks for being on again, and we will talk again soon.
Pleasure.